3, 2, 1. Welcome to the Weekly Update Show 3027.
Seriously, feels like that. The weeks go by fast now.
Yeah, they do.
Yeah.
We do this every week, and we've been doing it every week for almost 2 years.
2 years, yeah.
I actually haven't kept track because I just wanted to just kind of keep going. But I guess we should have like an anniversary date.
Yeah.
I have to go back and look and see when the first one we ever did. We did them live from my basement for like the first,
that's right.
I want to say 4, 5, 6 weeks.
Yep.
Maybe even more. I don't know how long it took us to.
Yeah, it took us a minute to outfit the place here. And
to get in here. We did one time. We did it out by the pool.
Yeah, your house. Yeah.
It was funny setting up all the equipment out there. I'm not doing that stuff ever again.
No.
But, all right, guys.
Yeah, that was good.
What do we got going on this weekend? This week.
So, this show is the last one before the TSP.gov site goes dark.
TSP shut down.
Yeah. So, let me talk about that in the order that we go to
Let's
here.
do
So
it, man.
here's what we got. Right, we're gonna talk a little bit about TSP going dark, and then there's a handful of terms that have been thrown around in the media, since January, since things kind of started going south.
By the talking heads.
The talking heads, yeah. And, I mean,
some could say we're talking heads.
Some could say we're talking out our ass too, but. You gotta follow who you think gives you information that rings true for you. That's
exactly.
that's all you can do, right?
And nobody's talking about the TSP except us. So
Right. So
we got that locked.
Yeah. So recession, inflation, disinflation, deflation, stagflation, and the misery index. Misery index I threw in there. That hasn't come up really at all. It was a kind of a term from back in the 70s, 80s, but it relates. So we're just going to do a quick slide on each one of them and kind of talk through it a little bit. And then the bonus chart is going to be kind of interesting. I think you guys will like that. It's a comparison of 2008 for the C Fund versus where we are right now on the C Fund. And then we'll do the regular it's like 2.5 year TSP Weekly Charts so we can continue to keep the COVID low in there for some perspective. Okay. So TSP.gov says on the site, right, quote, there will be a short period beginning at noon on Eastern Time on Thursday, May 26th, and ending sometime the first week of June, when we'll need to suspend changes to TSP investments. Okay. So first things first, noon on the 26th of May. We all know that if you get your IFT in by noon, you get that day's closing price. They're shutting down at noon on the 26th. So any transactions that you make in terms of IFTs or reallocations will count, right? You'll get that day's closing price. After that, until the site comes back up, you get your new username and password, and all the kinks get worked out. Until then, no changes are going to happen. Okay? So the other part of that is June 1st is a Wednesday. Okay, so my question is, it says they're going to suspend it until the first week of June. And I've asked a good handful of people this. What does it mean to say the first week of June when June 1st is a Wednesday? Right? Does it mean, so the 1st is a Wednesday, 2nd, 3rd, so the 4th is a Saturday, right? The following Saturday is the 11th. So that would be the end of the first full week of June that they could say that, hey, we got it up on time.
Yeah.
That's 2.5 weeks. That's being down for 2.5 weeks.
Yeah.
And then, of course, they could say, well, we needed to extend, whatever. But to get it done on time, it could be down for 2.5 weeks. So I'm just putting that out there just so you guys understand the scope of what we're talking about. Whether or not you want to stay in the stock funds or in the G fund, whatever, it's up to you. But the site's going to be down for potentially 2.5 weeks, best case. All right. So, recession. Okay, this is like the boogeyman. Everybody's talking about it. It is, right?
Yeah.
I mean, all you hear is any argument relative to recession, right? We're going into recession. We might not have a recession. We're going to have a soft landing. It's all based around recession. Well, what does that mean to me?
Mm-hmm.
Right? So here's the Investopedia definition of it, right? Recession is a significant decline in economic activity that lasts for months or years. Okay, an economic decline in economic activity. Experts declare a recession when a nation's economy experiences negative GDP, rising levels of unemployment, falling retail sales, contracting measures of income, all that. We talk about what the definition used to be 2 consecutive negative quarters of GDP. They've since kind of revised that to give themselves a little bit more flexibility, and they're going to call it a recession whenever they get around to it. But in terms of us as government employees or military people, what does a recession mean to us? We are basically in a recession-proof industry, right? The economy, recession. When you go into recession, layoffs happen. And I got a slide at the end of this. It's very clear what happens at the beginning of a recession and what happens at the end in terms of unemployment. But we are, no government employee is losing their jobs because of a recession. Okay, when the country is in recession, everybody is freaked out about losing their job. We are not. So we basically don't have to worry about it in terms of losing our jobs.
Yeah.
Our recession is a government shutdown, right? That's essentially what a recession is.
That's what it would look like,
right?
To the average person, yeah.
Right.
But when we talk about rising levels of unemployment, right? So here's my problem with most of the rhetoric that we hear about all of this right now, is we're still holding on to these sort of old definitions, these old narratives of pre-pandemic. Like, for whatever reason, doesn't matter why, we're on the I don't care why camp, right? We're like, it just happened. Right. But for whatever reasons, a lot of things changed during the pandemic that are going to impact for years to come. So we have these, when we say huge unemployment levels, what we're looking across you could argue it so many different ways. Well, what does that mean? When I go to, I haven't been in a store. I just drove up to upstate New York and back over the last 4 days. Everywhere I went, hiring, part-time, full-time, right. $15 an hour, $21 an hour I saw at one gas station. Yeah. That's just stand at the cash register, right? Yeah. So, and I'm not putting that down. I'm just saying, like, that's a lot of money to stand at the cash register. Like, that would have been, normally that would have been a minimum wage job. Right. That you would think of anyway.
And they can't get people to do it.
That's my point. Yeah. My point is, okay, so we can all argue, or I don't know, a lot of people make crazy arguments of why that is, and they got paid to be unemployed, and I mean, most of that is over, generally speaking. Yep. So what I think has happened is there's been a shift in the way people think about work. Yep. That's not just working from home kind of thing. It's just a shift of like what I can do and not do and still make my life work.
Sure.
Like pay the bills, do this. Like, I think a lot of paradigm shifts happen. But where I'm going with this is, again, this is just one piece of the whole idea of being in a recession versus not being in a recession. And our old narratives, they're not fitting anymore. They're not working. So when you see all these, folks on TV talking about it, like, you can see them kind of squirming in their seats because it doesn't fit the narrative. Like, all these rules that we had that says we're definitely this, and you've pointed it out in the charts before, where we showed how we kept rates so low till we had nowhere to go. And now it's like you can't lower them to get out of it. Right. Like, there's all these things that are so different than what it used to be that, like, it's hard to even wrap your mind around.
Yeah, come back to that, because I have a chart at the end of all this that is the FRED. It's the Federal Reserve database, and it shows unemployment rates at the beginning. It's a chart of unemployment rates, and then it shows the recessions in there, and it's very clear how unemployment used to. I'll say used to because I totally agree with you, and we'll see how it looks on the chart. But it's going to be kind of interesting. All right, so recession, the bottom line is, does it affect us as government or military employees? Yes. because everybody around us is kind of losing their jobs, which sucks. But
it affects the market.
And it affects the market.
It doesn't affect our industry.
Right.
That's
we're
the
not getting
difference.
Unemployed because of recession.
That's the difference. Yeah. Like our industry is recession proof.
Yeah.
Our retirement account is not.
Right.
Yeah.
Right. All right. So the other big one, everyone's talking about inflation, right? We talked about this before. It's the decline in purchasing power of a given currency over time. It really has nothing to do with the thing you're buying or selling. It's the currency that you're buying or selling it with. So a quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in goods, a basket of goods and services in an economy over some period of time. The rise in general level of prices, often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Everybody understands what recession is, what inflation is. It costs more to buy stuff, right? And we talked about consumer price index, which is that basket of goods. That's when consumer price index comes out and says that it costs more to buy this basket of goods. It's year over year or month over month, right? Depending on how they look at it. So, and you may not buy the things that are in that particular basket of goods, right? We all have to drive our car. That, energy, if you pay rent, housing, like a lot of food, obviously, goes into that. And then the other side of it is the producer price index, which the numbers come out at the same time, and that's what it costs producers to make the stuff that we buy. So those are the two really big numbers for me in terms of inflation. So now it gets kind of interesting. Disinflation. Okay, if you guys have heard this term, it's just it's a goofy term. Okay, so the definition again down here in Investopedia, disinflation is when inflation slows. Okay, it's a term used by the Fed when it wants to describe a period of slowing inflation. Unlike deflation, which is going to be our next slide, this is not harmful to the economy because the inflation rate was reduced marginally over a period of time. All right, I'm not going to read through this whole thing. The idea is that inflation is not rising as fast as it was last month. That's disinflation. It's like reducing the deficit, right? Another tricky term the Fed uses. So the national debt is the total obligation of the United States, right? The deficit, right? That's what they always want to talk about is the deficit, right? The deficit is the difference between what we create basically versus what we spend, right? So we almost always spend more than what we create, right? Because GDP is what we create. We almost always spend more than what we create, and so the difference is debt. It's more debt.
Right.
They call that the deficit.
Yeah.
That gets added to the national debt, right? So when they say we balanced the budget or we reduce the deficit, right? If you reduce the deficit, it just means you're not adding more to the debt. You're not adding as much as you did last year.
Right.
It's the same thing with disinflation. Inflation is still going up.
Right.
Gas prices are still going up. Food prices are still going up. Just slower than they were last year.
Yeah.
They had to have a term for that. Great. Deflation, right? Obviously, deflation is when prices go down.
It's the opposite of inflation.
The opposite of inflation, right? It's usually considered a bigger risk than inflation because the Fed has tools to combat inflation, right? It like it's doing now. It's raising interest rates to combat inflation and bring inflation down. The Fed doesn't have tools to combat deflation, okay? So in terms of what they say in Investopedia, deflation causes the nominal cost of things to fall. Deflation has been a popular concern among economists for decades. On the face of it, it seems like it would be a good thing because you can buy more goods for the same amount of money. However, not everyone wins from lower prices, and economists are often concerned about consequences of falling prices because particularly deflation can harm borrowers who now have to pay the debt that they got in dollars that are worth more than they were when they got out the loan. Yeah. It's the opposite of what it is now. So the reason you wanted to buy a house 2 years ago when the rates were really low is because you're gonna pay. If you looked at it and said, okay, I'm expecting inflation to move higher over the next couple of years, but for right now, I can buy this house. I can get a loan for this house at a really, really low rate,
Right.
right? So as dollars inflate, right, they become less valuable. Now you're paying off your house with less valuable dollars.
Mm-hmm.
If you're in a deflationary state, it's the opposite. You're paying off your loan with more valuable dollars,
Mm-hmm.
right? Not a place you want to be.
Right.
And everybody eventually sees that. It's like if you could buy a house today for $100,000, but tomorrow it's going to be $90,000. Would you buy the house today?
No.
No.
Yeah.
That's why deflation is the biggest problem for the Fed, because
Right.
they have no way to force demand.
And people also get confused with like how much my house is worth versus how much the money that I'm using to pay for the house is worth.
Right. That's a separate
It's
thing.
a whole different thing.
Your house is your house. If you upkeep it, other than the fact that it's deteriorates and whatever, it's the same,
Mm-hmm.
right? It's all of this is only about the cost of money associated with the physical thing that you're talking
Right.
about. It has nothing to do with the thing itself. My
Yeah.
house is not worth $1 million or $100,000 or whatever. It's worth it, whatever it is, because somebody can afford to make the payments to buy the loan to buy that house at that price.
Yeah. And it's funny because you pointed out here in this slide about how it's not necessarily a good thing when prices get so low, right? So, we're everybody complains about the gas prices. I do too. I just paid $5 a gallon in upstate New York. It was $4.99.
Yeah.
Like they did everything they could not to be $5.
Yeah.
And there was actually a little printed sign that they taped on the thing that said, probably going to be $5 by this weekend.
Yeah.
Right? I thought it was hilarious because I was in the middle of nowhere. But the point here is, though, is like, that's awful. But it's also not great if right now, I'm not talking about 1985, if right now it was $1 a gallon.
Yeah.
That is a sign of other issues.
Yes, definitely.
Right? So there's always a balance. And actually the reality is we want inflation and deflation. That's the part that the average person misses when we're all talking this financial Google gobble, right? And it took me a long time to figure this out. That first of all, we don't teach this in high school, and we should.
Yep.
Deflation and inflation are natural occurrences, right? It's supposed to work that way. What's supposed to happen is it's not as volatile, right? So we have all these mechanisms to keep it kind of in this range, reasonable range, and we all get along and everything's fine, right? It's when it goes wham and then bam and then wham and then whatever. That's when people are freaking out.
Yeah.
And that's kind of where we're at now, and our normal mechanisms for fixing those aren't working.
They're not available.
They're not available. And that's why they're not working. Yeah. It's very interesting times. It's scary to most people. And I hope if you're watching this show, you're here because you see that what we're trying to do is educate people to all of this. First of all, nobody teaches us any of this stuff in the military or in the government. They just don't. And so if you're lucky enough to kind of learn these things, one thing I think is the takeaway is the more educated you are, the less you panic. It's that case in many things, right? The more educated you are, the less you will panic because you're prepared. You understand it, right? The fear's less.
Yeah. It's interesting. Like I had an amazing experience. Let's put it in a positive spin. The housing crash.
Mm-hmm.
I had bought a house in 2005 that went under contract in 2005, and at the very end of 2005, it got delivered in February 2007. So it took about 14 months for the house to get built. Right. Every day, I had a 10-year arm, 7-year arm, something like that. And I'm like, I'm not going to live. I had never lived in the same place. I mean, a government employee. I lived in a place for 3 years. That's it. And I moved on.
Good luck being here longer than 3 years.
Yeah. So I'm like,
and we're still here.
Yeah, well, there's that.
Of us.
Yeah. But I had the 7-year arm, and I'm like, I can easily ride out any little ups and downs over 7 years. I mean, come on. Every single mortgage payment I made in that house, the value of the house, quote unquote, went down every single time I made a payment for 7 years.
Yeah.
I mean, and I learned a lot about how all this stuff worked during that time period.
Yeah.
And it got me to a couple years ago, I bought a condo because the rates were like 2%, and I'm looking at it, I'm like, inflation is absolutely coming.
Right.
And I knew I could pay the loan off with inflated dollars when inflation comes. And,
Right.
and,
You were
and I
making
know
your
rents are going up, and I know.
Right. You were making your decisions. There's a couple things in there, which I think is good takeaways for folks that are watching this. One is you learned, right?
Yeah.
Years ago, and I remember this because we were friends when you were going through all this, and I was on the opposite side. I had decided I was not buying anything because we were moving all the time, right? And so I rented, and I actually, mistakenly, not planned, came out better than a lot of folks because I didn't get into that market at that time. But the takeaway here is two things, I think. One is learning from those things, and two is the fact that, if you knew then what you knew now, you might have made those decisions differently, right? And so personal circumstances had a lot to play into why you did that. We don't have to go into all that. Family reasons, things that stability.
You have to live somewhere, and
you want to grow. Have the kids grow up in a great area and good schools and all that. When we talk about personal circumstances, that's what we're talking about. Is, hey, I've got 3 kids. They're getting ready to go into high school. I want them to go to a good school. This neighborhood, like, those are personal circumstances. The market doesn't care about any of that, right? Not the housing market or the stock market. They don't care. So you make those decisions based on your personal circumstances. What's going on in my life? Now, if you can balance that with making those decisions as an educated investor, that's the magic. That's the sweet spot. So you can take those two things and go, okay, here's where I'm at in my life. I want to do these things. My family expects these things or whatever. And I'm educated enough to know, okay, now let me balance those two things. And I think, we both have learned from past experiences where most of the decisions we make, we go ahead and make that balance. We're like, okay, what fits best for this, as an investor and as a human, living life and, having kids or not kids or married or not married or, later in life, earlier in life. Like, the problem is most people don't take both those things into account, I think.
Yeah, I would agree. Okay. Stagflation. This is one we haven't heard about since, I guess, the 70s. But it gets thrown around a lot now, right? The term stagflation.
It's funny because you hear it now and you're like, I kind of remember. Of course, I remember this from studying
history books
for the CFA. No, right? You have to learn all this stuff. But it's like, man, I haven't heard this stuff like the early 80s or something, right?
Yeah. So stagflation, the idea, it's characterized by slowing economic growth and relatively high unemployment, which is what they call economic stagnation, right? At the same time as the economy is shrinking, prices are going up. Because you would think that when the economy starts shrinking, prices go down, which is ordinarily what happens. But in the case of stagflation, the economy is shrinking, but prices continue to go higher. So you have inflation and a contraction of the economy. Stagflation can be alternatively defined as a period of inflation combined with a decline in GDP. Okay. So this is the biggest trick bag for the Fed right now. It's what they're trying to avoid by orchestrating what they're calling a soft landing, right? We talked about that last week, I think. Inflation is high, rates are low, and the market is dropping, okay? So the Fed has told us numerous times that it will continue to raise rates to bring inflation down. The problem is that it would have to raise rates like extremely high to really affect the inflation rate, right? And if it did that, it would crush the economy and the stock market. If it doesn't raise rates enough to bring inflation down, right, but it raises them enough to cause a recession, then we get stagflation. A period of both high inflation, because it hasn't raised rates enough to bring inflation down, and it put us in a recession with a falling economy and a falling stock market. It's the worst case scenario, and if they do not orchestrate a soft landing, we get stagflation. And that's why it's all over the media now, because
it could happen. It's a possibility.
It absolutely is a possibility. So for us, again, the economic contraction isn't as big a piece. The recession piece, because the industry is, the government employees, it's a recession-proof industry. But persistent inflation is a problem because our pay is fixed. Like, unless you go out and get a side hustle or something, your paycheck is fixed. The government's not going to increase, your GS level isn't going to go up, or you're not going to get step increase because because inflation is higher.
Yeah, you're not getting E6 or E7 because inflation's high.
No.
That's not how it works.
All right, last one. Misery index. Okay, and this is kind of interesting because of what we were talking about before. So misery index is basically, it was a thing they came up with in the 70s, and it's meant to measure economic stress of everyday people, right? And so all they did is add the unemployment rate to the inflation rate. Okay, so if a lot of people are unemployed, that's bad. If you're unemployed and prices continue to go higher, that's really bad, right? So that's misery. So that's where they get this misery index thing.
I got no money, and I can't buy anything if I did.
Right. And I'm looking, and the price only goes higher tomorrow than it is today, and I still don't have a job.
Right.
Like, it's brutal, no doubt about it. So since unemployment and inflation are both considered detrimental to one's economic well-being, they're combined, and again, I didn't make this up. This is Investopedia saying this ridiculous definition. Since unemployment and inflation are both considered detrimental to one's economic well-being, their combined value is useful as an indicator of overall economic, call it unhealth. The original misery index was popularized in the 70s with the development of stagflation, or simultaneous high inflation and unemployment. Okay, the last thing I wanted to point out on this is what we were talking about before. So here's that Fred chart that I was talking about. It's the unemployment rate, okay? And it goes back to 1950. So what happens? Unemployment rate in here is like 3.5% or something. As soon as the unemployment rate starts to tick up, we go into inflation, or into recession, right? So the gray, all these grayed areas here, they're all times of recession, okay? So the chart is of unemployment. So when unemployment ticks up, that's when we go into recession. As soon as unemployment starts to tick down, we go out of recession. It's the same way every single time. Every single time back to 1950. Every single recession we've had. Now, that's why the talking heads now are saying, because unemployment is low and it's not going up, we're not going into recession. So, is that because of the Great Resignation? I mean, we don't have, unemployment right now is 3.6%. It's historically low. I mean, it's really low, right?
Yeah.
But does that mean that everybody has a job? I mean, if we're in this environment of the Great Resignation, I don't want a job.
Mm-hmm.
So how do you measure unemployment if people don't want a job?
Right.
Because all back 50s, 60s, 70s, 80s, you went to work. There was no alternative. You went to work.
And I mean, this is going to dive in deeper, but you know what unemployment rate doesn't encapsulate? I always messed up that. I can't pronounce that word as well as I should.
Pronunciation is good.
Yeah, encapsulate is, so a lot of people that I know, at least, or that I follow or talk to or whatever, talk about this being an entrepreneurial economy where, so if you don't have a job, we just had lunch with a friend, right, who went from having a job
Yep.
to having their own, business. They make a thing and sell it, right? And so they are now an entrepreneur. And so they didn't want a job. They wanted to do, so that doesn't get counted.
I don't know.
That doesn't get counted.
Well,
so that is unemployment.
She has a company, right?
Yeah, So where I'm going is
because we're in the same boat.
We're in the exact same boat.
Right,
we don't have employees.
Right.
It's us. But
so I wonder if we're actually counted as employed. Right.
Yes and no. So what we look across, so we say unemployment is low. This is where I'm going with it.
Yeah.
Unemployment is low, but you look across and you see so many job openings.
Yep.
One of the theories is many of those people decided to go work for themselves, right? Whatever skill set they had, they, in many different ways decided to get paid for doing that, right? And so we talk about this, right? So there's a W-2 work, there's a 1099 world,
yep.
and then there's
a dividend world,
right? So there's three worlds you can live in to work and make money, right? And if you fall in the W-2 world, that's where most of these statistics come from. If you're not in the W-2 world, you're hard to track.
Yep. Yeah,
And
that's
so
true.
I have a feeling that we're not tracking the data the way we think we are, and we don't have another mechanism to do it. So it goes back to these talking heads, or the only data they have available is that, well, unemployment's low.
Right.
Well, I mean, is it? It might be low, but there's a lot of jobs available.
Right.
So where are all these? So anyway, I just think it's distorted. I don't know.
No, I agree.
Yeah, we don't have the answers, folks.
That's
but
why I thought it was really interesting. Like every single show, my pen doesn't work.
I was going to say the same thing. Every single time you use this thing.
Yeah. Every single time unemployment ticks up, we begin recession.
Right.
I mean, it doesn't matter how high whether we started down here below 2.5 or we started up here above 5%. Every time we tick up, we go into recession. I mean, we're up here at 7.5%. We tick up, we go into
so for
recession.
the sake of explanation, though, why that big spike up and down? Why is it so steep?
This one?
Yeah.
That was COVID.
I know.
Yeah, but you can see how quick and actually I thought that was interesting when I was putting the chart together. So, industry's closed.
Mm-hmm.
So that's actually a good thing to think through. So when you got was it PPA or whatever, the loans to keep your business running, to continue to pay your employees, right?
Yeah.
A lot of companies continued to pay their employees to stay home.
Yeah.
Right?
Stay employed. So they were technically employed.
So then why did that number spike like that?
Yeah, I don't know. So the devil's in the details when it comes to statistics.
Yeah.
Because you can use them lots of different ways, right? Once you understand statistics. So it really just determines, how they did it, how they tracked everything, what they counted, right? But I think for me, the takeaway from all of this is that you can't trust one single data point.
Indicator. Yeah. No.
You can't trust one single indicator, which we talk about all the time. Yep. So when we're looking at the market, when we're looking at these charts, there's some indicators that are stronger than others for us, but we're not going to put our whole retirement account on one indicator.
Right. Yeah.
And we're also not going to put our decision-making capabilities in the hands of talking heads on TV.
Right.
Because none of them are talking about your retirement account.
No.
They're talking, first of all, they're talking to Phil Air. First of all.
They're talking to get paid.
Right? They're talking to Phil Air, right? Time. And it's 24/7 now, so they got to talk. That's their main motivation. The second motivation is, I want a little bit of fear or drama or,
Yeah, drama, no doubt about it.
Yeah, so you got to get your facts from all over the place.
All right, let's switch gears for a second, right?
So I don't want to see this chart. I haven't seen it yet.
Yeah, no. This is kind of spooky, to be honest.
Don't scare people.
Okay.
It's not Halloween. Wow.
All right. So let's just start on the left. Okay. These are two different charts. Okay. And obviously I blacked out what they were and all that. Okay. So let's start on the left.
You're gonna see if you can pick which one is which.
This looks pretty much exactly like this, right? We got a channel. We got a channel. They look almost.
Yeah, if you don't see the resemblances here, you're not looking.
You're right. We got a big drop. We got a big drop here. We come up. We put in a high. We put in basically essentially the same little lower high. And we put in a high. Put in a high, little lower high, put in a high. Then we have a big fall off. So pretty much, to right here, it's almost the same chart, right? In the top one, we get a higher high. So this one had a higher high than this one. This one did not have a higher high than this one. You could call it that maybe as the actual recovery, but whatever. Anyway, they didn't align exactly, but this is 1 month of time.
So this is all one year?
This is also 1 month of time. No, they're a little bit. They're not exactly the same time range.
Uh-huh.
So that's why. But this, like between these black lines, is a month.
Uh-huh.
Between these black lines is a month. So
okay.
So they're close, but they're not exact. All right. So let me just kind of cut to the chase. This is the top in 2008. This chart. Okay. This is where we are right now. Okay. So if we go to the next one, this is 2008, and this point right here is where that last chart ended. Okay. Not to say that this is what's going to happen over the next year and change, but this is what happened on the same kind of chart setup in 2008. I didn't do the Vixx on the last chart, obviously, but if you pulled up this chart of where we are right now, which I'm kind of going to go to next, but for anybody who's been following the Vixx at all, in 2008, the Vixx kind of kept topping at about 35, but the lows kept getting higher.
Remind everybody what the Vixx is.
It's a fear index.
Right.
It's a volatility index, but when the market goes down, the Vixx spikes. And then when the market goes higher, the Vixx retreats. It comes back down. But when you're in a consistent bear market, you keep getting higher lows in the Vixx. Okay, and you can see higher lows like all the way through until we had the big drop. So this, by the way, if you're still in the stock funds right now, if you're watching the show and you're still in the stock funds, this is the thing you are really trying to avoid.
Right.
If you're just buy and hold, and I don't care what you guys say, and I'm going to stay in the stock funds forever.
Why are you watching
then
this?
I don't know why you're watching it. But
why are you even watching this?
One of my friends, I was talking to a guy last week, and he's down 15%. He had a tough go of the last alert. We did an alert back in April that I ended up losing 2% on the round trip. So from the time I did the first alert to get back into the stock funds and the next alert to get out, it was 2 days. And I was only in 50% in the C fund, and it cost me 2%. And so right now, like if you follow our alerts, you're down about 4.5% for the year. So this one friend of mine, he's like, he didn't get out on the second day when I'm like, nope, that's it, I'm getting out. He didn't get out, and it continued down. And we talked through it, and he was down 15%, and it killed him to move to the G fund at that point.
Right. Right
now, the C fund's down 18.5%.
Yeah.
So, and who knows how much lower it's going to go?
You're still out.
Right? You're out. And you're not worrying about it going lower.
Right.
And when the trend changes, we'll pick it back up and get back in on the other side.
Yeah, Jerry and I were talking about this yesterday, or maybe earlier today. I can't remember.
Yesterday.
But and you guys are going to start to hear this more and more from us now. We always get this question of, I missed the alert, or I came in afterwards. What should I do now? And so, I think and you guys can help us with understanding this. Meaning, if like we don't explain it right, put some comments and tell us, because in our mind, generally speaking here, if you believe in the principles in which our methodology is based on, Jerry, created this methodology that says, listen, be in the stock market when it's trending up. Be out of the stock market when it's trending down. Pretty damn simple.
I created that.
Right? Yeah. Yeah. Now, the part you created, I would say, is be in the stock funds, right? In the TSP. Yeah. Be in the G fund when it's going down, right? And at the end of the day, the first rule is don't lose money. Because we think of our retirement account as it is an account. So meaning if it's going down, the value of my account, the amount of money in my account is going down. Okay? That is it. I don't care about there are no tax implications. I'm in a retirement account. I don't want my balance to go down. Okay. I only want it to stay the same or grow.
I don't care how many shares, what the price I paid for shares, like none of it matters.
But and if you lose track right in there, then like keep watching our show and keep listening to us, because I think this is the hardest thing for people to kind of grasp is we're not buying and trading stocks like you are in a normal brokerage account. We're not doing that. And so are there similarities? Yes. But at the end of the day, if you are on a 401k, an IRA, or a TSP account, a retirement account is not what they're talking about on TV. It's not what they're talking about. So not to belabor this, but the point is start paying attention to those principles, folks. And if you believe those principles at some point, I bought into the principles, and that's why I'm here today, right? Over the years, many years ago, I bought into those principles, and I was like, well, that makes sense to me. So when it's trending up, I'm in. When it's trending down, I'm out. Like, that's it. And it became very simple to me. Yeah. And so when there was an alert to get out, got it. It's trending down, I'm out. Right. And if you follow those basic principles, why would you be in the stock market right now? Forget about the alerts. Forget about I missed it. Right. If you look at that and you say to yourself, the market is still trending down today, right. and you believe in these principles, those two things together, why are you in? Right. You have the answer. You don't need us to tell you, hey, Jerry, I missed the alert. Hey, Jerry, I just joined, and you guys were in the G Fund 3 weeks, 4 weeks ago, whatever. Okay, look at the trend. Where's the trend at right now? Is the trend up? Is it a confirmed trend up? Yeah. Be in the stock funds. Right. If it's a confirmed trend down, be out. Now, if you don't have any moves left, that's a different story. Yeah,
you wait until next month.
Different story, but you can always go to G. So I know anybody listening to us right now, anyone listening to us, you have the capability of going to the G Fund. Sure. And the G Fund is up 3% for the year?
It will be by the end of the year, yep.
Right. So my point here is you guys have the answers to these questions. And what we've decided is to keep kind of, pounding on those principles. Yeah. Follow the principles and they work in your favor, right? If the stock market's trending up, be in it. It's not right now. So if you're in it, you're either ignoring the principles or you don't believe in them.
Yep, right.
That's it. From our perspective.
Which is fine. You might have other principles that you think is
1,000%. You may be playing this game a totally different way, and that's fine. Yep. All I'm saying is if you're watching this and you're trying to learn what we're talking about, you either agree with those principles or you're ignoring them. Yep. That's it for us.
Yeah, and
I've ignored the principles before.
And it's painful. Implementing them is painful. It can be, right?
Of course it is.
Nobody wants to go to the G Fund if you're 15% down. No. But the reality is if the trend is down, until the trend changes, it's down.
Right.
Why do you want to be in the stock funds when the trend is
And if you don't believe us, just pay the money for the Investor Business Daily.
Yeah, sure.
Look at I forgot what it's called again.
The market update, I think.
Something like that, where it tells you market trending up, market trending down, market, just follow that. Yeah. Like they're generally in agreement with what we're doing.
They're doing the same thing. They have a little specific algorithm that tells you from their perspective when the trend changes.
Bottom line is, why would you be in? It's totally different. If you're short in the market right now, you're making money.
Yes, you are.
We're not talking about all that stuff. We're talking about retirement
accounts.
TSP. All right. Back to the slides.
Yeah, let me pull out one other thing from this one. Because it came up quite a bit on Facebook this week. Like we said, Vixx at 35 here for quite a while, right? Back here in 08, we had Vixx at 80 at the bottom. So can you get Vixx at 35 and have that be a bottom and have a recovery rally? This was a 16% rally over like 3.5 months. If you got the exact bottom, I actually did the math today. If you got the exact bottom here, you got back into the stock funds, C fund at the exact bottom and got out at the exact top, you made 16%. If you drew the trend line, so remember you were in you had a high here. So for 1, 2, 3, 4, 5, 6 months, you're in a decline. Why you would have picked that bottom, I have no idea. You wouldn't. You would have drawn the trend line, gotten back in maybe when it broke it. So now you've only got a couple of percent until it rolls over. And you're not getting out at the top. You're drawing this trend line and getting out here. So you're probably not making anything on that recovery rally. So a lot of people right now are like, I'm waiting for this recovery rally. We thought it had started, what day this week or last week or something, that was up 3% or something one day, and then kind of, you're not going to pick it.
This isn't a daily game.
No,
this is a weekly, more importantly, probably a monthly game, right?
Yeah.
Weekly is about as Now, you can watch it daily to look for the trend changes. But you should not be making choices about your retirement account with a day's information.
Yeah.
It needs to be at least a week.
So anyway, Vixx can get much, much higher than 36, I think, was the conversation on Facebook. Personally, I'm looking for a bottom in the market today before we get some kind of recovery rally like this, hopefully at a Vixx at like 40. But we'll see. So, okay, so this is where we were in 2008 as of the last chart, right? And this was going forward, and we don't know. So here's what that looks like for us. Okay. We are somewhere in here. Do we get some kind of recovery rally and then roll back down? You know, it's absolutely possible. It doesn't mean it's going to happen. We're up here at a low at Vixx at 35, a low, you know, right now it's 31. I mean, it's just not that high, right? It's not that high. It's not like this, right? And again, I absolutely have no idea that could this happen going forward? Absolutely. Is it a foregone conclusion that it's going to happen? No. And it doesn't really matter because I'm not trying to predict going forward.
Right. We're not timing the market. If you're not getting that from watching this show all the time, we're not timing the market. We're not predicting it. We have no idea what's going to happen. But I tell you what we have is a plan if it goes one way or the other.
Yep.
That's it.
100%. All right. So we're going to wrap it up with the TSP fund charts. Nothing much has changed. The only interesting, for anybody new watching the show, here's the thing. The blue line is the 20-week exponential moving average line. So here's the low from COVID. Once price got back above that line, it got support every single time it came back down to it. Every time until January 2022, till it didn't, right? And since then, it hasn't been able to get back above it. All right, we were above it for 2 weeks right here. And then we rolled over, and for the last 7 consecutive weeks, the market has moved down. Okay? We are oversold, right? We're below that 30 level on the RSI. We're oversold. We're almost as oversold as we were at the bottom in COVID. But it doesn't mean that we can't stay down there for a long time. Price can move much lower, and RSI can stay down there and stay oversold for a long time, just like it stays overbought up here for a long time, right? It got overbought right there. What is that? And the price kept moving higher, right? Until the 20-week moving average line comes down and price gets back above here, there's no chance of a sustained move higher. It has to get above that line before there's any chance of a continuation of a move higher. That's the C fund. S fund, same thing. S fund is worse off because it had its high back here in November. And you can see every time it tried to rally back up to that 20-week moving average line, it's now acting as resistance, and it's been a rough couple of months for the S fund. It's been oversold for 3 weeks, right? The C fund just got oversold this week. The S fund has been oversold for 3 weeks, and in the last 3 weeks, I mean, that was from here. So it's already gone down, that much, and it's been oversold. So just because it gets oversold doesn't mean it's time to buy it. That's what I'm saying. iFund, probably going to finish the week positive, but huge reversal. And you can see that flat. It's been almost oversold for the last several weeks. So this is just no point in being in the stock funds from my perspective. F fund is kind of interesting. For the past couple of weeks, we've been talking about how the F fund appears to be hitting a bottom, which is interesting because the Fed keeps telling us that they're going to raise rates to bring down inflation, and yet the bond market is starting to tell the Fed you can't do that. And so that's not something we need to get into right now, but it is kind of interesting because the Fed doesn't drive the bond market. The bond market tells the Fed what to do. And we've had 2 consecutive up weeks for the F fund. And if you drew, if you drew the trend line, we're out of the the immediate range. So if I were looking at the F fund, if any kind of weakness, if we get down here somewhere, but we can't get below these lows and then we pop higher, good chance, as much as it doesn't seem to make sense right now, it's a good chance the bond funds rally. But the other interesting thing on this chart is you can see how long the F fund has been oversold. I mean, you're talking about back here. F fund got oversold like back here. And so the majority of this move down happened while the F fund was oversold. So just because it gets oversold does not mean it's time to buy it. All right.
Questions.
That's all I got.
That's all you got.
That was a pretty good one.
That was
right?
a lot.
Yeah, there was a lot in there.
All right, guys. If you enjoyed the show, please share it with your friends. If you do have questions, put them in the comment section wherever you found the video. Facebook, YouTube, Skylink, Starlink.
All that. So this is the last show before TSP goes dark.
Yeah.
Doesn't mean we're going dark. Just means TSP is going dark.
Oh, my gosh. Can we please take a weekend
cannot go
off?
on vacation. I know it's Memorial Day. Yeah, Memorial Day.
Yeah.
Day?
Next.
Next weekend.
Yeah,
and,
it is.
I'm hoping all the contractors that are working for Accenture and A-Light and the other guys that are putting together this new TSP that we're going to get are working overtime because I'm hoping that we get this thing up, sooner than later.
All I know is it's going to be fun to talk about either way.
Yeah.
But the TSP will go dark after you see the show at some point next week.
Yep.
And, hey, we're all in this together. So we'll figure it out. Keep watching the show. Share it with friends if you like it. And we will see you next week.
Next week.
Cue music. Bam.